Alright guys, welcome back to the channel. Got a bit of a treat for you today because about 3 years ago I was over in New York and I recorded a feature-length episode on how to get involved with trading if you're a beginner. And I go through kind of everything you need to know if this is brand new to you. And I featured on a friend of mine's channel, Ryan Scribner. And we did a feature length on exactly step by step what to do. So I thought that I never put it on my channel, so I'm going to release it on this channel now. Now, although a couple of the things regarding equipment are slightly out of date regarding, PC tech, PC specs and stuff like that. So I've kind of put some updated data in the link in the description below. But other than that, it's very, very solid advice and still very, very relevant. And as I say, a few years ago now, but I'm sure you're going to enjoy it. If you're new to trading, please take notes on everything I go through in this video, and you'll be off to a great start with a huge edge, armed with knowledge on how to approach trading. So grab a pen and paper, sit back and enjoy.
How's it going today, guys? Welcome back to the channel. I'm here in New York City with a man by the name of Jason Graystone. It's the first time I've ever talked to a trader on the channel here, so it is super exciting. You're all the way from London.
Yep.
So thanks for taking the plane trip out. I certainly appreciate it.
It's great.
And so why don't you go ahead and start by doing a introduction about yourself, what it is that you do.
Yeah, thanks for, first of all, thanks for having us on the channel. It's a real joy to be out here in the New York City.
Aside from the traffic,
Aside from the traffic, yeah, and the humidity. But
yeah.
For those of you who don't know me, my name is Jason Graystone. I'm a professional currency trader, and I'm also a co-founder of a company called Tier 1 Trading. We specialize in helping people achieve financial independence through speculative strategies in the financial markets. I'm frequently #1 author on TradingView.com. I've featured in blogs and podcasts. I'm currently writing a book which will be out later this year. And I'm also invited to speak around universities in the UK and take part in research for business development and things like that. So I'm really enjoy entrepreneurialism as well as trading, but trading was what allowed me to be financially independent.
Yeah, we were talking about that a little bit off camera. I think it's super interesting, but for you, trading was a way for you to kind of escape the traditional work environment that you weren't really a fan of?
Absolutely. For me, trading is something different for everyone, and for me it was a vehicle to get to a point where I just had time. I wanted the time to decide how I spended that time, and it was a way to accelerate my wealth in order to do that. So that was my motivation for it.
Yeah, I know that's one of the most frustrating things is when you don't know exactly what it is you want to be doing. You don't have the time to figure it out. And so I think for a lot of people, maybe they focus on wanting the money, but really it's more important to figure out why it is that you want that. And
Absolutely.
That's really incredible to say in order to figure out what I really want to do with my life and what really interests you on a natural level. So
for me, the money is just the byproduct. It's not, you need a why, and we're going to go through that because the reason I wanted to come on this channel is I really resonate with Ryan's approach. And if you're familiar with trading at all, you're going to see that there's a lot of shit out there, right? I can say shit.
Yeah, that's perfectly fine.
There is a lot of unethical educators. There's a lot of people selling dreams, false expectations, and people are really falling for this stuff and losing a lot of money. They really are, and I lost a lot of money myself. And over the years, I've worked with thousands of traders, and I've seen a lot of predictable patterns. I've seen what works, what doesn't work, and it is a massive failure rate. It is a massive failure rate.
Yeah, do you have any numbers on that as far as what it is? I know it's quite high, and some of the stuff I've looked at before, it's most people are unsuccessful with it, right?
It's about 90%. Yeah.
That's about what I've seen too, about 90% are unsuccessful.
Yeah, we know that from broker statistics that about 90% of people lose 90% of their capital within 90 days. So it's like a 90-90-90.
90-90-90, that's not really a good, well, it's easy to remember, but yeah, I mean, that's what I've heard about trading as well. And so obviously you guys who have watched my channel before know I'm a long-term value-oriented investor. So looking at both of us, we're kind of polar opposites here because I'm more focused on the fundamentals of a company and you're looking at strictly charts, right?
Yeah, absolutely.
And you're looking at currencies. So you're looking at just trading based on patterns, right?
Of course, and I was always, the reason this fits so well is because I was very much a passive investor. I invested in businesses, stocks, real estate investment trusts, and startup businesses as well. But they were very, although you take the startup businesses aside, they're very passive, boring investments. They were long term, and I had an appetite for risk, and I wanted to just accelerate a little bit. So I started exploring speculative markets like options and Forex. And I went into Forex and I blew around 36 to 38 grand initially.
That's how much you lost?
Yeah,
is that the learning curve that people usually experience, or is that just kind of...
I think I made every mistake possible.
Okay.
Yeah, I followed, signals and all the bad stuff that I'm going to go through with your listeners. But after that, I became very good. I learned a lot about what didn't work, which allowed me to become really good. And I later on realized that it's actually, you should be focused on not what you're not losing rather than what you're gaining. And if you can just focus on that, you become very good. So I went through all the crap. There's a lot of scams out there. There's a lot of automated systems, signal services, people selling pipe dreams. And over the years, I've been fortunate enough to work with thousands of traders in multiple countries, over 50 different countries. And what we've seen is very predictable patterns in why people fail, because we've been analyzing data on the behavior patterns of people, how engaged they are, how accountable they are, what are they watching, what process are they taking, are they going from the start to the finish, are they skipping, are they jumping, jumping ahead, do they actually want it, have they got realistic expectations? And I've produced a framework almost that will guarantee your highest probability of success. Obviously, it's down to you as a trader in the end.
Based on looking at the behaviors of past students and past people who haven't had a good experience with it.
Absolutely. Yeah. And if you follow the framework in this way, which a lot of it is down to psychology, by the way, the skill is the minority, believe it or not.
And that's pretty much the same thing as well with investing in the stock market. It's the psychology of it, as far as the investing goes and the fundamental analysis, that's based on looking at the numbers and the principles, but it's a totally different experience actually doing it. And as far as like the risk side of it goes, I know you mentioned that having that greater risk appetite. I know personally, I dabbled around with swing trading very early on in my investing career. And I can remember I had $500 I was swing trading, and it was keeping me up at night worrying about it. So I learned early on that I do not have the risk appetite for much of anything beyond what I'm doing now. So I think, is it something, how do you know, I guess, when you have that risk appetite? Is it something you just try it out and you find out if you do? Or?
Yeah, I think by the time I'd lost 36 grand, it wasn't just blowing 36 grand in the market. That was a long learning curve. It was over 18 months to 2 years.
And how did you feel about that?
I felt...
did it make you feel like a bad person, or you just felt like, okay, I'm getting there?
I felt frustrated. I did try to look at it as a donation to my education rather than a big loss. But at the same time, that's a lot of money. That can be a life-changing amount of money to lose. And fortunately, I was I'm a businessman, and I'm not stupid, and I would never trade money that I couldn't afford to lose.
Yes.
But it's still a lot of money. And by the time I'd lost that much, I really sort of felt like I owed it to my family as well. Like it wasn't just me anymore. I was like, that's multiple holidays, and and I was thinking all the money that I'd blown, and I really just needed to knuckle down and get it done. And I knew, you're so proud as a person. You think, you don't want to be told that you're doing things wrong, and then you do know, and you just keep doing it, and then by the end of it, you're like... Oh.
Well, there's no such thing as a free lesson out there. You either pay for it in terms of paying for education, or you make mistakes and you end up losing money. But that's like, I have a friend of mine who trades options, and he'll text me sometimes saying he lost 20, 30 grand in a day, and it's like, but you can tell that it doesn't affect him. Really, I think what it is, if you feel like less of a person after losing that money, then you probably shouldn't be involved in something speculative, because it's just money. I mean, it's a tangible thing, but it doesn't make or break you as a person. No. I think a lot of people tie their worthiness to their monetary value. Yeah. And I think you have to have that separation there to really do something like you're doing.
Absolutely, and it's really important as well, before we get into it, I'm going to talk about it in a bit, but it's really important to build a trading system around your lifestyle and your personality, because if you don't, you're essentially doing something that isn't aligned with your comfort zone, and you're just not going to succeed. And it doesn't need to be that way. You can build systems around your personality so that you've got the best chance for success. So I'm going to go through a bit of a framework based on all the information and the data that I've analysed over the years. And I want to just, before we get right into that, I just want to sort of debunk some myths, because some of your listeners are probably thinking, I get asked all the time, isn't it gambling? Is it risky?
Sure. And I've said things about that on the channel about it, because to be honest, I don't know a lot about the trading side of, really, I don't know much about it at all. So.
No. And like anything, the markets are the market. They just do what they do. And it's not the market that's risky. It's the approach you take to the market that's risky. So if you think about a casino, for instance, you've got one-arm bandits, you've got poker table, you've got blackjack, you've got roulette. And the reason the casino comes out on top in the end is because there's no one who's consistent. There's no one with an edge. They just go there, blow some money. They've got no strategy, no plan. And they are approaching the casino as a gambler, right? Whereas if you look at the winning poker table, it's always the same players there. It's always the same players at the top of the tournament. They're winning the tournament time and time again because they've got an edge. They're not approaching the casino as a gambler. They're approaching the casino as a business. It's like they've got an edge. They've got a risk management strategy, a money management strategy. They know when to get in and get out. They know when to stop, and they know when to continue. And the markets are exactly the same. The market you cannot control. It just does what it does. So it can't be risky. The market can't be risky. Your approach to the market is what's risky.
Yeah, that makes sense. Yeah.
So lots of people think that it's risky gambling, but it's down to you to approach it professionally as a business, for it not to be a risk. We're looking for an edge.
So if you approach it like you would the casino, you're going to get a similar outcome more than likely, right?
Of course. And before we go on, I mean, people come to me and say, I want to be a consistently profitable trader. Well, the clue's in the title. Like, you have to be consistent.
Not all the time, right? And not every trade?
Yeah, absolutely. And you just need to show up and do the same thing. And we're going to go into that in a bit. Secondly, people think that you have to be intelligent. You have to have a high IQ. I came out of school with one grade, and that was art. And it's just simply not true. And if it was true, you would see a lot more brain surgeons ditching their 250 grand job to earning 7 figures trading because they're far more intelligent than me, right?
Sure.
So that's absolutely not true. The next thing is that people think you need to know about all the global affairs, what's going on in the country.
Sure, current events and what's going on in the political landscape and everything.
Absolutely. Unemployment rates, bank rates, all of that type of stuff. And that's not true either. So as a technical trader, I'm looking for patterns in the market. I couldn't care less what's going on in the world. If the market doesn't affect me, the bank rates don't affect me, Brexit doesn't affect me. I'm just looking for a probable edge out of patterns in the market that are predictable. So you absolutely don't need to know about all the global affairs of what's going on. And lastly, on that, people think you need lots of equipment, lots of
I've seen like the 6 TVs, 6 computer screens, and all kinds of stuff going on and charts. So do you need all that, or is that just kind of something that helps you, or is it complicate the process?
I started trading on a 15-inch laptop, so you absolutely don't need all those screens. I would say once you get down the road, it's good to have 2 screens at least, because, and I'm going to go through some equipment that I recommend for you guys if you're looking to start trading. 2 is good because you can have the markets, and you can have something else on another screen if you're doing other things, but you absolutely don't need 6 screens. Down the road, the reason they have 6 screens or 8 screens is because they've got a lot going on, and to make it easier, they have different charts and different screens.
Sure.
You're not going to be on Wall Street from day one, and you absolutely don't need tons and tons of equipment.
Okay, well, that's something that's a myth debunked right there, because that's something I figured you needed, the 6 computer screens, and I've said that in the past. One thing that was interesting, I just wanted to mention, I was looking at one of your videos, and you said there have been times where you go like a very long span of time without a trade because the right pattern doesn't show up for you.
That's right, yeah.
What's the longest span you've gone without a trade?
There's a saying that you don't earn money from trading, you earn money from waiting. And it's absolutely true, although essentially it is trading in the end, but trading requires a lot of patience. And one of the other myths is that people think that you always have to be in a trade when you absolutely don't. What we're waiting for is a set of rules to play out, and then we know we have a paper-thin edge over the market.
Sure. The
probability of what's likely to happen next based on that pattern happening provides us with our edge, and if we can consistently trade that pattern,
That's how we earn the money. So that could be 1 week, that could be 5 in a day, that could be once a month.
Wow.
And that's how it goes.
So it's really about the patience.
It is about patience. It's about patience.
That's also, there's people who think similarly when it comes to investing. They think they need to be all in the market at all times, and if they have any cash, they're like, oh, I gotta get this money to work. I gotta put it to work. And then you hear about people going all in with the stock market, investing all their money, and then they have no mobility there. If a deal comes along, they can't buy anything because they're already all into the market. So it's very similar to that patience aspect and knowing when to hold them. Hold on to your money and say, okay, I'm going to wait for a better opportunity, or look for what it is that you're looking for.
Absolutely, and bearing in mind that the purpose of this video is to give you the best possibility of succeeding into trading, if that's something you want to do. The last thing I need to mention on this bit is it's not don't look at it as a get rich quick vehicle. Like, if you're trying to think about how much money you can earn from trading, you're really missing the elephant in the room. It can be the fastest way to grow your wealth. I've invested in businesses, I've invested in property, I've invested in stocks and shares, and this really is the most rapid way to accelerate wealth. But if you're just chasing the money from day one, you're
in it for the wrong reasons.
You're in it for the wrong reasons, which is leading us on to really the first step of the framework. So the first, and you'll know just as well as I am, the first step in the framework, the most important thing is to actually want it, right? And what I mean by that is, so many people out there are sort of fantasizing over someone else's dream. Mm-hmm. They see someone that's hit a trade, or they, this crap where they're flying around in rented helicopters and Lambos and the money.
I've seen it all.
Of course. And
flashy lifestyle, that kind of in your face, showing off your rich.
Absolutely. And what people do is they go, well, what are you doing? And they say, well, I'm trading. And then they go, oh, I want to trade. But do you want to trade? Because I'm telling you, if you don't enjoy actually looking at the markets and enjoy solving the puzzle, you're not going to stick with it, because there's lots of hard work down the line that you've got to put in.
Yeah, people tend to ignore that hard work piece, and they just see, oh, this guy's driving a Lamborghini. I can do that too if I start doing whatever he's doing. So
and it's not for everyone. Trading isn't for everyone.
Do you have to have a natural interest in charts and patterns and puzzle solving, like you were saying?
I would say that you have to actually enjoy looking at the markets and coming in each day, and you don't have to look at them all day. You can do day trading, swing trading, which we'll go through, and you don't have to spend lots of time in front of the charts, but you do have to have an enjoyment for the psychology in the markets and going through the charts, because there's lots of backtesting data that you need to accumulate so that you've got the psychology to put that into your plan, and you have to just actually enjoy doing it. So know that you actually want to trade, because that's the first thing that's important. And why? Because the monetary value or the monetary gains from trading is, it can be life-changing. And I was just with a couple of Wall Street traders, and they said the same thing. It can be life-changing, but you don't. What's the money for?
Sure.
Because it's just money.
Right.
There's some kids in the prop firm. They're just driven by the money, because they haven't got that. They're just out of school. They're just trying to better the other person for more money, it doesn't really mean anything to them. They're just trying to get more money because it's a competition, like a benchmark.
Who can have the most money in their bank account, not really why do you want that money. And it was interesting too, you were talking about some of your motivations for doing what it is that you do and wanting to give back to people around you, and really the more money you have, the more good you can do for the world and the more good you can do for people's lives.
Sure. For me, it is to free up my time to do what I want to do. And as I said to you earlier, I ask people, or if people say you're driven by money, these are the sorts of people that I say, well, how much would suit you? And they say something like, well, $500,000 or $1 million would do me. That would sort me out and my family. And I think that's very selfish, because you're just thinking about you and your immediate family.
Not the people around you or your community or people you could really help.
Absolutely. Yeah. I'm thinking much bigger term, and when you can teach someone the realistic expectations and they get results, that's life-changing, and there's not a better feeling than that. And even the Wall Street traders that I was with yesterday, even they are going into education, because there's just so much rubbish out there.
Yeah.
It's important to get the information right, because it's giving it a really bad name, as you can probably you've probably seen.
So just to tie it in here, in case you guys aren't sticking around for the whole interview, you have a whole YouTube channel, right, where you do videos like this, educating people pretty much for free. And
Yep. Yeah, I've got my own YouTube channel. My personal channel is Jason Graystone.
I'll link that all up down in the description below for you guys too. But in terms of just kind of giving back, that's one way that you do it as well, just by kind of making videos, helping people, showing them the basics.
Absolutely, and I've got a book coming out later this year that you can go and read. But we're going to go, through this video, we're going to go right into the technicals. I'm going to show you actually how to make money in the Forex market.
Sure.
So it's going to be really valuable for your...
So if you end up taking a pause from this video, bookmark it and come back to it, because it's going to be a long one, but a lot of value in this one.
It is going to be a long one. There's going to be a lot to take in. I'm not going to give you like everything, because that will be days.
Yeah, that would be a couple of days. We'd be stuck here sleeping at some point. But
it's going to be a good one. So the first step, as I went over, was the want and the why. You have to know that you actually want it and why you want it. The second thing is expectations. So this is the next problem. People, because of the way it's advertised on TV or these adverts, people think they massively overestimate what's achievable in a short space of time. So the first 12 months, say.
Sure.
They think that they're going to double their account in a month. They think they're going to be on yachts in a year.
Yeah.
And it's just just not realistic. It's not realistic. It's not going to take you. I'll be very surprised if it takes you less than 12 months to really go through the process and learn properly. And have a system that you've tested and paper traded even, and then gone out into the markets. I'll be very, very surprised. But then because of that, when they actually start doing it, they figure out it's quite hard. They blow a load of money, and then what they do then is they underestimate what's achievable from 12 months to the 24 months, say.
Sure.
And that's when the results can really, really compound, and you see exponential growth, and people get turned away by that. So what I want to do is just give you some expectations. So it's going to take you around 12 months to really, really learn. And then after that, the money, if you can just go through the process in the right way, the money just comes.
Now, in that 12 months, how many hours a week or a day are we talking about here?
It depends what type of trader you're going to be, and I'm going to go through that in a bit more detail, but you can do anything from, the testing is what takes the most time. The testing is what takes the most time, because you're essentially testing a strategy back in time, and that can take, you want to go back about 5 years, and that can take a long, long time, depending on how many markets you're going to be looking to trade.
Sure.
So that's the most time consuming and the most grueling bit, and I'll go through the process of that. The next thing is people just go into it not really knowing the numbers, so they don't know what they're going for. It's like they're just trading. Am I going to replace my income, or aren't I going to replace my income? What am I doing with the money? And there's a very, very simple formula. And you talk a lot about stock market investing and passive income, right? Building passive income streams. And essentially, if you've got any sort of liquid assets like money in funds, you've got some cash, a cash buffer, some savings, anything like that, essentially all you're doing is you're taking that and you are working out your expenses for the month, and you just want to minus your trading income divided by your assets, and that is essentially it. And what that'll give you is a figure in time. So if you're getting paid monthly, say for instance you've got $5,000 in assets or cash, right? And your expenses are $2,000 a month, say. If you're bringing in $1,000 in trading income per month, well then if you do the math on that, the 5,000 divided by the 2,000 minus 1,000, which the calculation is here, you're going to have 5 months. You can buy 5 months. You've got financial independence for 5 months. You've replaced your income for 5 months.
I've never really thought about it that way. That's very interesting.
Right. And by having that sum in place, I knew what I was going for. It wasn't just a dream. It wasn't just.
So it was a tangible number. Absolutely. What you were reaching for, not just some pipe dream like a Lamborghini or $1 million out of nowhere.
Absolutely. And by doing that, you have something tangible, as you say. Here's a great thing: as you get better and better at trading, you can match your living expenses, which then, your financial independence.
Sure, and then at that point you don't have to go work if you don't want to do that.
And
right?
you free
That's
up
the
your time.
Situation you were in, right?
You free up your time, and as you free up your time, you can earn even more money because you're focusing more on trading.
More energy and efforts onto.
Absolutely. So you got it. So just not have your numbers, work that out, know what you're working towards, and know that it's going to take you a while to learn. All right, so that's expectations. The next thing that's really important is accountability, self-accountability, because it's all on you. With other markets, if you've got a shop, you're selling a product, you're relying on customers, you can blame staff for not showing up.
You have excuses.
You've got excuses. You can blame like the supplier for bad goods. You can blame the economic crisis. You can blame
the weather.
Blame the weather. Blame the traffic. Blame the geographical location your shop's in, and everyone's gone vegan. Right? You can blame things. With trading the markets, it is all on you. If you lose money, it's your fault.
Right. And that's kind of something I've heard from people as well, is they say like, oh, the stock market stole money from me. And it's like, you handed it over. If you lost money, you have to at least own up to that. You can't blame the market. It didn't reach into your bank account and pluck out money.
We hear the same thing. And it's like, oh, the broker stopped me out, or the broker took my money. And if you make statements like that, or if you hear people say statements like that, it just shows a lack of knowledge towards how the orders are executed in the market. So absolute rubbish. But you need to know that you've got to be accountable. Self-accountability is absolutely key. Secondly, you've got to be accountable to not go off and chase the shiny object. You've got to stick at one thing. Otherwise, it's just going to take you forever. This is what I struggle with. You think that someone's got a better system, you go and follow that.
Yeah, you're jumping around from one thing to another and just kind of dabbling with it.
And it's so inefficient. Yeah. Like if you just have one thing and go for it and don't worry about
what everyone else is doing.
Yeah, just focus on one thing, one system. Trust me.
And that happens a lot of the time too with the stock market. If there's it's kind of a social thing. If you're investing, you talk to your friends who are investing, and you hear about your friends in a certain stock, and maybe you're not happy about the one you're in, so you say, oh, I'm going to sell this and buy that, and you end up jumping around, generating a flurry of activity, and really having no success with it because you're not really doing it for the right reasons. No, you're just trying to.
It's not a strategy.
Yeah, there's no strategy to it. It's just, okay, what's this guy doing? I'm going to follow him.
Absolutely.
Okay, so now Jason is going to jump over and give you guys some recommendations as far as what equipment you need to get started with this whole process. So we'll see you guys back here in a bit.
Sure.
All right, in this lesson, I'm going to be going over the equipment that I think you need to be able to trade professionally. Now, there's lots of common misconceptions about needing thousands of pounds worth of PC equipment and 6 monitors and so on, and that's simply not true. When I started trading on a 15-inch laptop, and I did most of my testing on that laptop as well. So in this video, I'm going to go over what I think are the minimum requirements, and then I'm going to go over what I think you should really have if you have the budget for it. So if you only have the budget for the minimum standard, then go ahead with that. And if you don't have the budget for the minimum standard, well, you can either not trade or simply go with what you have. So when I start talking about i5 or i7 processors, and you say you only have an old Core Duo, then you can start on that. But if you're going to treat this as a business, I really believe that you need at least the minimum specification laid out in this video. So you may be aware that technology moves very, very quickly, and it becomes dated quite quickly. So if the last time you upgraded your PC was over 3 years ago, say, then it's likely that the software or the hardware that you're running is out of date. So the first thing you need is a decent processor. And if you have recently bought a laptop or a PC, the chances are you already have one. It's going to be an i5 or an i7 processor. The minimum requirement, in my opinion, would be an i5 processor. And if you have the budget, well then an i7. The second thing that's important is the RAM. What RAM does is it allows your PC to run multiple processes at once. So if you think of the processor being the brain of your PC, well then the RAM is how many different things the brain can juggle at one time. And what I recommend is 4 gigs of RAM as a minimum. Now I'm going to suggest to you that you go with an 8 to 16 gig of RAM, but if you buy a new PC or laptop, it's likely to come with 8 gig unless you specify otherwise. RAM is very cheap, and if you get the chance to upgrade when purchasing, it will be well worth investing in that upgrade. Otherwise, you may get down the road and wish you had done it when you bought the PC. But just know that 8 gigs of RAM is enough. So next on the list is an upgraded hard drive. If you think of RAM as processes handle at once, then the hard drive is the memory. It's the place that stores all of the processes that aren't being used. Now the speed of which it can grab the unused processes depends on the speed of that hard drive. So you can have a lot of RAM and a great processor, but if it takes your hard drive a long time to find the information that the RAM and the processor is asking for, then you'll still have a slow machine. Now many machines will come with a traditional hard drive such as a 1TB hard drive, 7200 RPM SATA drive, and it will get the job done for most people. But since you aren't most people, and you are a trader in the making, I'm going to recommend that you upgrade to a 256GB solid state drive. Now there are a couple of examples here. The first one is a Samsung SSD 830, which is very good. The next one is a SanDisk SD SSDP-256G25. Now the next thing I'm going to go over is a solid graphics card, because crashes aren't fun. A graphics card will allow your PC to run smoothly without lagging, crashing, and run multiple programs and use multiple monitors if you want to without getting that blue screen of death. And then you have to restart your PC, and you don't want to have to deal with all that. So you don't want a graphics card that's too small, especially with all the charts and live data that you'll be using. And I have two recommendations here. The first one is an nVidia GeForce GTX 680, which is an amazing graphics card. It's what graphic designers use for CGI. And the other one is an nVidia GeForce GTX 760, which is nowhere near as expensive as the first one and will happily run a couple of monitors. But if you want to be able to run 3 or more monitors and you're that type of person, then you may want to go for something like the 680. So the next thing is monitors. Now, don't believe that you need 6+ monitors to be able to trade successfully, because you don't. You can just use one monitor. I would recommend having a second screen purely because you can use one for your chart testing and one to log your results. You can use one for your analysis and the other to place trades. Or you might be part of a live room where you want the live room on one screen and your charts on the other so you can follow along. It simply makes your life easier, and that's really the only reason. I have 6 monitors. But if you think of all the stuff that I do, I run a webinar, have news and social feeds going on, have the lower time frame pairs, the higher time frame pairs, the screen recording software running, and I need to keep my eye on a lot of stuff at one time. Especially as I'm talking to people in the live room and explaining my analysis in detail, I need to be able to keep an eye on things as I trade live in that room, and I don't want to miss anything. But for you, it's really just not necessary. And with regards to monitors, I use the AOC 27-inch HD monitors. But in my opinion, you really should have two qualities. The first is that the monitors should be HD, so the charts are crystal clear. And the second is that they are anti-glare or matte finish screens. These two qualities will ensure you don't strain your eyes when spending hours in front of the charts whilst learning and testing and even trading. Now the last thing is your internet connection. A decent internet connection is essential to trading. Execution is critical, so you need your connection to be fast, working, reliable, and not cut off just as you're about to place an order. Or a news event comes out and you can't get your stop loss in place. It happens, so do your best to make sure it doesn't. I would recommend an upload speed of at least 786 kilobits per second and a download speed of at least 3 meg, which is very common these days anyway. But make sure you can get fast internet. Don't skimp on it. It will cost you in the long run, believe me. Alright, so just to recap, you need a computer with an i5 or an i7 processor, 8 to 16 gigs of RAM, upgrade to a solid state hard drive, upgrade your graphics card, a monitor that won't fatigue your eyes, and a solid internet connection. And that's it. And even if you go with the low end of all of that stuff, you'll still have a great trading machine. It's going to do everything you need it to do. So that's it. That's what I recommend. And if you have all of that, then you're good to go. Now this must be one of the most commonly asked questions that I get. What charting software do you use? What charts are those? What do I need? Is it okay if I use this one? Is it okay if I use that one? And I know you're probably seeing tons of different trading platforms advertised on the TV or web, and you have absolutely no idea what one you would need. So I want to share with you what I think are a few of the best charting packages that you can use. I'm going to go over just 3 different platforms and give you the advantages and disadvantages of all 3 in my opinion. Now firstly, there are a few functions that I think you need on a good charting package. The first one is flexible movement. In other words, you want to have that 360-degree movement so that you can easily manipulate the charts whilst doing your analysis. The second thing I think is very important is to have real-time data connection. You don't want a delay in your data because this will be detrimental to your trading. The third thing is a full set of indicators. You want to have all the indicators at your disposal should you require them. Now, I use very little in the way of indicators for my own trading, but you'll need to have the RSI, ATR, and the Fibonacci indicators as a minimum. So the first platform I'm going to recommend is TradingView.com. TradingView.com is a completely free charting package that offers extremely flexible and powerful tools in real time. You can now link your broker account to that package, and you can place trades on the charting package as well. For charting and analysis, this is a great package. It has the 360-degree movement on the charts. You can set watch lists. You can set alert levels that will email you or text your phone when the market has reached them, so you don't have to be at your PC all day. And all of your analysis is also saved on the screen until you delete it. So you can close the web page, open up on another PC, and it will all be there just as it was when you left it. It has all the tools and indicators, and the developers are frequently releasing new tools and features. This package will give you news releases, you can place demo trades, so it's good for your forward testing or demo trading, and it will even log your performance for you. A couple of downfalls to the package, in my opinion, is the lack of data. You can currently only go back around a year or two, which means if you're testing strategies on the 60-minute time frame or even the 15-minute time frame, the chances are you're not going to get that 100 trade sample size that I recommend. Now, the second thing is that this platform has a social media aspect to it as well, where you can share ideas with other traders, which is quite cool, but the only downside, in my opinion, is the forum section. This can be extremely damaging and dangerous to traders because trading is a fairly lonely business, and some traders get tempted to participate in the forums, and this results in Chinese whispers, lack of correct information, or just simply the urge or temptation to check that next shiny object, which we're trying to move you away from. Now, this will end up with you getting lost in the abyss again, and that's not what we want. So don't get me wrong, this is a great platform, except there isn't quite enough data in my opinion, and the forum section should be approached with caution. The next platform I'm going to recommend, purely because it's still very popular, probably the most popular trading package, and you may or may not have heard of it, but that's MetaTrader or MT4. This package is clean, it has all the indicators you will need here and can place trades directly on the chart, so it's a charting package and a trading platform in one. The downside to this platform, in my opinion, is the indicators aren't very user-friendly. The charts aren't easy manipulated and can be quite limiting when it comes to the more advanced trading strategies. The platform is free, and as long as you have a data feed provided by your broker, you're good to go. Now, the last trading platform I'm going to recommend is NinjaTrader. NinjaTrader is a very crisp, clean, and extremely flexible charting package. Again, it's a charting package and a trading platform in one, so you can place trades live on the charts, and all of the tools are extremely user-friendly. The charts are easily manipulated and everything is customizable. The platform again is free if you have a data feed from a broker, and you can save different workspaces for different portfolios or backtesting and real trading workspaces. Also, the platform offers advanced ATM strategies, which means once you get slightly more advanced, you can code your own automatic trade executions. This is the platform that I use, and I think it's a great package, not only because of everything I've just mentioned, but to top it off, they have an outstanding support team with tons and tons of video tutorials on their YouTube page. So there we have it. You no longer need to worry about what platforms you should choose and what charting package to use. I would say go and have a play with all three, get a feel for which one suits you best.
Okay guys, welcome back. So now Jason is going to go into more detail here about really identifying some of these patterns in the market, correct?
Yep, that's right. So first thing I want to talk about is the difference between fundamental analysis and technical analysis, because there's no right or wrong. You know, there's people that rubbish either or, and the truth is there's no analysis that tells the future. So, there's
as much analysis as you do, you have no idea what's going to. I mean, you can kind of manage your risk involved with investments, but there's never a guarantee that the market's going to go any one way or another.
No, so I think it's crazy when people say, "Oh, you can't use technical analysis." It's crazy, right? So fundamental analysis is more news-based, more the economic data, what's going on in the world, and really, the reason that I don't like to use fundamental analysis for trading is because you're not guessing the figure or the result. You're guessing the market participants' reaction to the result, which is impossible. Like you don't know how people are going to react to a certain news release or a certain event.
It's the same way as well with investing in companies. When you're trying to bet on an earnings report, you can guess about what the numbers are going to come in at, but you could have one thing in that earnings report that people don't like, and that stock can go in the complete opposite direction of where you're expecting it to. So
absolutely,
I completely understand you on that piece.
Yeah, 100%. And with technical analysis is based on psychology. So there are patterns in the market, although people think the patterns are, we never know what's going to happen next in the markets, right? But contrary to popular belief, there are patterns in the market that have stood the test of time. They're not entirely random. And the way that we build our edge is to identify a sequence of patterns in the market so that we know that if we get this pattern, then it's likely to do this next.
Sure.
And then what we're looking to do is build rules around that pattern. So if we see something that happens frequently and we go back and test that and it's happened frequently for 5 years or 6 years or 10 years, then if we can build rules around entering that, exiting that move, then we've got a high probability, we've got a positive expectancy. We've got a system that provides us with a positive edge, a statistical positive edge. And that's really all we're looking to do. So the reason I love technical analysis is because we don't have to worry about what's going on in the world. There's a saying that a technical trader can trade the market regardless of knowing the market. And although that's not entirely true because you have to test the markets,
sure.
What they're saying is because of the technicals, it's the patterns we're looking for. It's not necessarily the market. It could be Apple, Google, it could be currencies, it could be futures. It's the patterns we're looking for in the psychology. Now,
can you make money in both bear markets and bull markets with this type of strategy? Does it matter if it's going up or down?
Yeah, it makes no difference. That's one of the great things about Forex, which is you can short the market and you can buy the market.
What's the majority of the trades you're doing? Are they betting against or are they bullish trades?
So with investing, for instance, what you're really doing as a passive investment is you're hoping that it goes up.
Sure.
Right?
Yeah,
so
usually it's asset appreciation. You're going to buy it and eventually sell it down the road at a higher price or collect your dividends.
Absolutely.
Yeah.
With the Forex market, it's a bit different. It essentially moves sideways over time. So although it might be going bullish for a long, long time, it will end up at the same price that it was at sooner or later.
Sure.
And we can go short, we can go long, and the Forex market actually consolidates for a longer period of time than it actually is in a trend. So 70 to 80% of the time we're in consolidation, some form of consolidation. And only 20-30% of the time we're trending.
Do you trade when it's in consolidation or no?
Yeah, so I've got strategies for bullish, bearish, or consolidation. And another important thing is to be able to adapt to that, and not just be arrogant and sort of stuck.
Right. I mean, yeah, if you can only make money at a certain, and that's also like people who only can make money during a bull market with investing. You have to know how to make money in all. You got to be an all-weather investor or trader as well, all-season trader. You can't just be able to make money at a certain time and then say, all right, I'm going to take a break for 9 months or wait for,
It's an interesting point, and I think it's important that you just touch on this again, that trading isn't investing. Trading, we're not just going long and holding.
Yes.
That's not what we're doing. We're trying to get in and out and catch a move in the market that has a high probability so that we can get the profits out, and that's it. We're going in and out.
Now, how long is it? I'm sure it varies, but how long do you usually have a trade open then? Is it you close them at the end of every day, or do you have some overnight?
Yep, I do about 3 hours a day trading a day, and they're sort of in and out within half hour. I really day trade for the education piece, so that I can show people what I'm doing, the methodologies, the process. If I wasn't doing education, I'd purely be a swing trader, so 4 hour time frames. I'm in the trades from anything for 2 days up to 2 weeks maybe.
Okay, so you're holding it overnight. I guess that was one of the other misconceptions, is that all day traders close everything by the end of the day, or is that true? Or
so with the stock market, it's close at the day. With the Forex market, if you're in the UK, it closes at 10 o'clock on Friday night and it reopens at 10 o'clock on Sunday night.
The Forex market. Other than that, it's open 24 hours Monday through Friday?
Yep.
Very interesting.
Yes.
So you could, if you wanted to trade at 2 in the morning, you have the availability to do that?
You can trade 24 hours.
Okay.
Right, so now I've been over the technicals and explained a bit about the patterns in the market. What I really want to do is show your listeners how we can identify these patterns. So I'm going to go into my trading desk and give you guys an example.
Okay, sounds good.
All right, so as mentioned just now, we're going to look at the way that markets move and how we can identify some patterns. And I'm going to be going through a simple pattern that I want to share with you that then you can go and identify for yourself. So the first thing I want you to be aware of is the market moves, how the market moves, okay? Because what you've probably seen the market move up, and you've probably seen the market move down, and you've probably seen the market move sideways. Well, when we're moving up, we call this a bullish trend, and when we're moving down, we call this a bearish trend. And when we're moving sideways, this is either called ranging or consolidation. Now, when we see the market moving in any direction, there's certain things that we can pay attention to that are likely to cause a reaction or the market's likely to respect. The first thing is going to be even-handled numbers. So if we're talking about the market being driven and you know, the patterns in the market being respected by psychology, patterns being psychologically driven, one of the things we're paying attention to are even handle numbers. So anything like a dollar flat or 1.5 or 1.1, 1.2, anything with an even handle number, the market tends to respect more often than it doesn't. Okay, so not every time, but more often than it doesn't. Remember, we're going for that statistical edge. Another thing that the market respects are numbers with 50 in it. So anything with 50, so 1450, 1550, 1350. So 50 and even handle numbers, just bear in mind that that's respected. And any time that the market respects any psychological number, what we see is structure. So the next thing we're going to show you is how the market moves. So what you'll see is this cyclicity where we see cycles in the market of a new high, a retracement, and then we'll see a new high, and then we'll see a retracement, and then we'll see a new high. And the market moves in ebbs and flows like this. And usually the structure, this is what creates structure. And normally these structure levels are created by even handle numbers or significant levels of importance that have been respected previously in the market. Now, what also tends to happen is as we push up, what we call this is a resistance level, and what we call this is a support level. So this is like the ceiling where we hit resistance. This is like the floor where we bounce, we hit that support level. What we normally find is that when we put in new highs and we push back down, previous resistance then becomes support. So the structure is actually respected as well. So one of the things I just want to touch on is how to identify a trend. And then what I'm going to talk about is how we look at the end of the trend and we can predict a reversal. So first of all, to identify a confirmed trend, we're looking for a 3-point move. So we're looking for this move, the retracement, and then the new structure high. And then what we know is we have a high probability that the market's going to continue up until we violate this previous outside return or retracement here. At which point we're in consolidation, and then we need to look for that 3-point move again, 1, 2, 3, in order to make a prediction that we're likely to see a continuation to the downside. So normally we see this, 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 until we end up reversing again, violating this outside return or retracement, and then we look for that 3-point move again. And it just continues like that. And the reason we do that is because once we hit that 3-point move, we know we have a higher probability that the market's going to move up or down depending on what direction we're going in. Now, the pattern I want to talk to you about today is many different ways to make money in the market. And I've been over certain things that affect structure in the market, like even handle numbers, 50 levels, previous structure, and historical levels that have been respected time and time again. But what I want to go over in this video is when we spot a reversal. So there's a pattern that happens frequently at this point that we can use to short the market at the end of a bullish trend, or if we're in a bearish trend, we can then look to buy the end of the bearish trend and look to buy this up. So there's a simple pattern here called a double top. Now, you might have heard of this referred to as a V-top, but it's a double top, and essentially what it looks like is this. We get to the end of the trend, we then have a small retracement here, and then one final push up. We get rejected at this test, and then we fail to put in a new high, and then we roll over. And this is called a V-top or a double top, and I'm going to go through the rules of this right now. Okay, so let's just say, for instance, that the market's been pushing up and we've identified our test, our initial test, and then we've started to retrace. What we're looking for this to be considered a valid double top is a test of this high. So this high wick of the candle, we're looking for a test of this level, so this zone here, for the second test. So what we're looking for is a test of this high, and what we can't do is close above this previous high. So if the candle pushes up and closes above this previous high, what we're talking about then is a continuation to the upside. So it's important that we wait, and we wait for the close of this candle, and as long as it doesn't close above the high, it can do this. It can push up and put in a higher high, but it can't put in a higher close. So we're looking for a test of this zone. We cannot close above this high, and as soon as we get a valid retest, which can look like this, it can look like this, okay, it can even look like this, or it can look like this, okay, because we've tested this zone and we haven't closed above. Soon as we get this formation, this is considered a valid double top. Now, normally the double tops are price and time symmetry on the retracement, so we have price and time symmetry on the retracement as well. But essentially what we're looking for is this little V, and then we're looking for a retest of the initial test high, but not a close above the high. And this is what we call a double top, and what we're looking for after this is to enter a trade on the next candle, and then we're looking for the market to roll over.
So now you've got a grasp on how to identify some patterns. What we're going to talk about is how you actually build a trade plan, because this is essentially going to be your business plan for being a trader. And what I always say to people is the first thing you want to ask yourself is when deciding what time frame to trade or when to trade is, when can you consistently be in front of your charts? Because people have jobs, people run errands, people take the kids to school.
Sure.
They got their shopping coming on Tuesdays, they've got the bins going out on the first.
Yeah.
Right? When can you actually consistently dedicate time to being in front of your charts? Because what we're going for here is consistent profits. Mm-hmm. So everything needs to be grounded and based off of a consistent plan. So it makes no sense for someone who's got a full-time job to try and check charts at
their desk or sneak it in between.
Yeah, or they're phone to a client, or they're rushing for a meeting. It's silly. Just, you don't want to do that. First thing you want to do is go, right, when have I got an hour to dedicate? It might be at lunch, it might be an hour after work, after the gym. When
but
the kids
uninterrupted time, basically.
Just uninterrupted time.
Yeah.
That's all. It doesn't matter if there's more volatility. It doesn't matter what's going on. Just make sure it's a dedicated time that you can just dedicate to being consistent. And then just find one pair for now, one market. So don't try and find lots and lots of different markets. Don't scour through different markets. Just get to know one. I always like to think of it when I met my wife. I met her in a bar, and all I knew about her that night was she liked white wine. Right? That's all I knew. The next day, when I rang her up and wanted to meet her again, we went out for dinner. I knew what food she liked. And then I knew what pattern when she had lunch, when she was out on Sunday. If you can just get to know one market first, you're going to get to know the market. You're going to understand more about that market and how it behaves. Mm-hmm. The markets behave in different ways. There's different markets that behave different ways. And it's best just to know one pair. And if you're looking at what market to look at, just pick one of the majors. So one with the dollar in it. So you're going to get a bit of movement. Any pair with the dollar dollar's the base currency for the world. And if you pick a pair with the dollar, you're going to have some movement. Sure. So it's not going to be boring. There's going to be something for you to test. There's going to be something going on, but just pick one. So euro dollar, pound dollar, Aussie dollar. anything
And
with a
I
dollar.
believe that's familiar or similar too as well with people who day trade. They usually only trade a basket of stocks. They have a couple that they've learned the personalities.
Yeah.
They typically don't just, pick one out at random. They kind of learn the personality of each one of these stocks. And is that kind of the same thing as what you're talking about here?
Absolutely. I always say that, trading is a business. And these markets that I've got on my screens are my employees. They're my employees. They've
Sure.
got different personalities. Some perform better under pressure. Some perform better in the summer. Some show up late. It's very, very similar to running any type of business. And if you look at it like that, you're going to appreciate that some are going to perform differently. And also, if you did start a business, you wouldn't employ 30 people on day one.
That's a very good way to explain that, yeah.
Right? It's insane. You just wouldn't.
It's kind of like, because I talk a lot about passive income on the channel, they say the average millionaire has 7 sources of income. You get people who want to start all 7 at once. And it's like, what are you going to do? Dedicate 1 hour a day to each one and then become a millionaire? So you do one very well, and then you move on to the next one. So
Absolutely.
there's a lot of ways that's applicable.
And then once you've got your pair then, and you've got the strategy, what you want to do is you don't just want to take every single setup that you see. If you was to go through different markets and apply one strategy, you'd probably have thousands of different opportunities per month. What we want to do is we want to add some filters to that so that we get the higher probability moves. So although we've got an edge by identifying a pattern in the market, what we really want to do is identify the really high probability. And you can add things like filters. And what I want to do now, for your listeners, is just show you how we go back to that example I just gave and then add some filters to that to really give you the higher probability trades. So let's jump back to the desk.
All right, so as we're building out a trade plan, what we want to do now is take the double top principle and we want to apply some filters so we're not taking every double top that we see. Because if you just apply those rules and you look for those rules for a valid double top, you are actually going to see them form in many places that don't provide high probability trading opportunities. So what we're doing is we want to build some rules, build out a plan and say, I'm going to have some filters in place so that I only look for these trades in the highest probability zones. So taking into consideration what I've been over already, what we're going to look at is we're going to see that we've pushed up here, and you can see that we've held this level before we've started to see a retracement. So we're monitoring the market pushing up, and we've seen a hold of this level, which just so happens to be the 0.950 level. So if you look over here on the right, we're at a psychological number, that 50 level. And we've hit that level. And what I'm going to say is if we zoom out now, so if we just zoom out this market and we go back in time, we've put our horizontal line in and we've scrolled back in history and we've seen, actually, we've tested this level once, twice, 3 times, 4 times, 5 times, 6, 7, right? And we've held this level much more often than we've broken through it. So every time it's tested, it holds more often than it doesn't, okay, before it's violated. So what I'm going to say is you have a rule in your trade plan to say I need at least 3 previous touches of this level before I consider entering this trade. So the first rule is a minimum of 3 previous touches of this level before I take the trade. The next thing I'm going to look for is something called the RSI. So this little squiggly line down here is the RSI, which stands for Relative Strength Index. And what this does is it indicates overbought conditions in the market. Now, I'm not going to go into too much detail on this right now, but just know that if we've pushed above the overbought condition, it indicates that the market's running out of steam. So if we couple this as a filter with the fact that we're at a psychological number that's been tested 3 times, at least 3 times previously, we're likely to see a little retracement. Now we've seen the retracement already, so now what we're looking for is that second test and that rejection, that hold of this level. So what we're going to do is we're going to watch what price action does next. We know we're interested in this level. Now we're going to peel our eyes and wait for the rest of our rules to be met, which I'm going to explain right now. Okay, so you can see that price action started to push back up, but remember the rules of the double top. we need a test of the high, the previous high, which is this little zone here, the wicks, the high wicks of the candle. We need the price action to push up and at least test that zone and not close above the high of that test. So let's see what happens next. All right, you can see that this candle here hasn't quite tested the zone. It's pushed up, but it hasn't quite tested the zone, therefore it's not valid, so we can't take the trade yet. And what I'm going to be looking for on the second test, you know I mentioned that we were overbought. What I'm going to look for is some bearish divergence. So I'm looking for equal tests of this high, and I'm looking for bearish divergence, so a slope down on the RSI, equal tests of the high on price, bearish divergence on the RSI, and that's going to be used as another filter. So far we have psychological number, okay, which I've moved, psychological number, at least 3 tests of the level previously, overbought condition on the initial test, and then bearish divergence on the second test. And by waiting for those filters alone, it's going to turn your trading opportunity that you're looking for, your trading strategy and your plan, into a very, very high probability system. So let's see what happens next. Alright, so you can see on this candle we've actually tested the zone. We haven't closed above the high, so what we can do now is actually sell the market next bar market. So what that means is, as soon as this candle closes, and we have to wait for this to close, because if we don't wait for this to close, the chances are we could push up and close above the previous high, which would mean it's invalid. So we wait for the close, we wait for the candle to close, and then we sell the next bar market. And then what we want to do is we want to put our stop loss above the high. And I'm going to use a 10 pip stop loss. So we're going to go 10 pips above. So we're going to be up at 60, 0960. And we're going to take profits off, for this example, at a retest of the low. So we're just looking for a pullback down into a retest of this low. So we're going to sell this now, next bar market, and we'll see what happens next. So there we have it. You can see that we've rolled over. This is a high probability because we waited for those filters to be met. We didn't just take any double top that we saw. We waited for those filters, which gave us an extremely high probability of being right. And in fact, you can see here that we continued down even further. So that's how you identify a trading strategy, a pattern in the market that happens frequently. That's how you add filters to it to make it a very, very high probability trade rather than just taking those low quality trades. And that's how we combine it all together to really give you those high probability moves. So let's just say, for the sake of this example, that this risk here where we entered was 1% of your account. Then if we just clone this, you're going to see that this was about a 1.5 to 1 risk reward, which means this would be a 1.5% profit on your account in one trade.
So hopefully you can sort of get a bit more excited about how we can really hone in on those high probability trades, and instead of there being thousands of different opportunities, we're honing into like 10 opportunities a month here to really get those high probability trades out of the market. And what that does is it suits many people's personality, because if you're like me, I personally like to be right more than I'm wrong, and I like to win more when I'm right than I lose when I'm wrong. And I just like that edge. Some people, some traders I know, they're happy being wrong 7 times out of 10, and they're happy with that because they've got a much bigger risk reward profile.
Okay. So is that based on your personal preference, or is it kind of based on your risk tolerance, or you just kind of figure that out through testing it out?
Absolutely. It's your personality, really. It's so important to build it around your personality. If you're not happy if you're not happy being wrong more than you're right, then it just don't have a system that does that.
Sure, yeah,
right.
Makes sense.
I like being right at least 50% of the time, because then I know I can make money with money management, and I'm going to talk about money management now. So once you've found a system that is profitable and it's proven to be profitable, where the real money's made is through money management. So this is a strategy. If you think about a coin flip, if I was to flip a coin, if you flip a coin 100 times, over that 100 times, you're likely to be right 50 times, right? Sure. So 50-50 flip. If every time it was heads, I paid you $1, and every time it was tails, you had to pay me 50 cents, you're going to want to flip that coin as many times as possible because you've got a statistical edge of having 50%, but you're going to win more over time.
Yeah, you're not going to lose as much when you lose. You're going to make more when you're right.
Absolutely. So that's called risk management. If you was to add a money management strategy to that, let's say, for instance, every time you hit 10 winning trades or 10 winning flips, we increase the size. And every time you lost 5,
you decrease.
Okay. So what we're doing is we're protecting our capital as we're going for a bad period, because there will be losses.
Sure.
There are losses. And then we're increasing your capital or your position size as you're doing well, as you're going through those hot streaks. And what that does is it allows you to accelerate your account and protect your capital.
So one question that I have, I'm not sure if you touched on this previously, but how much, if you really want to get started with this and you want to go through the whole testing phase and you know you're gonna lose money, how much money do you realistically need to have in order to get through that learning curve and kind of figuring this all out?
Yeah, I think let's talk about losses then, for instance, because there's a cost of doing business, right? So whether it's, as you said earlier, whether it's education.
There's no such thing as a free lesson out there.
No, there's not, and it is a business. So you've got to buy a laptop, a PC, right? Which I've been over. The equipment, you might have to have a membership to a trading platform.
Sure.
It's a cost of doing business, right? So they're overheads. And with the markets, the losses are the same as any other business, except they don't come in the same order. So if you think about a product, if we sell a physical product, we've got a markup on that, but we've got overheads, okay? And we've had a cost of producing the product. So if we sell a product for $10, we might get $3 profit at the end of it. And every product we sell, we know that we've got to pay the overheads, we get $3, and we've got the profit. With trading, the losses are just the cost of doing business, and then the profits, they don't come on every trade.
Okay.
It's over time. So you could have a week of losses, and then you could have 2 weeks of winning trades. So it's not on every single trade that you get the profit and loss. And that's what people really struggle with, because they think, oh God, I'm losing trades. But that's why it's important to stick with a plan, because you know you've got a statistical edge over time.
Sure.
So
is it really about just consistently showing up and applying the same principles each time?
Absolutely. We're going to talk a bit about backtesting now, because now you've got the plan and you've got the rules and you've got, you understand money management. The first thing you need to do, or the last thing you need to do, I should say, before you go live, is to test the system. Now, this is the thing that's skipped most. This is, I would say that 98% of the people that go into trading don't do this bit.
Really?
Yeah.
Do you think this is a big part of why that failure rate is so high?
100%.
Okay.
For me, take my example, for instance. For me personally, it was the turning point. It was what changed me from just blowing money to being very consistently profitable. Sure. And I'm going to talk a bit about backtesting. So once you've got your market and you've got your system, your strategy, you want to go and test that over time. So use your historical data that I went through on the trading platforms. And what you're looking for is a minimum of 5 years or 100 trades, whatever comes first. So depending on the time frame, if you're very small time frame, you're looking for 100 trades, which might be 2 years. Or if you're on a higher time frame, on the 4 hour or the 60, you might have to go back 5 years to get the 100 trades, right?
Sure.
So you want a minimum of 100 trades and or 5 years of data.
Okay.
What the backtesting phase does is it gives you black and white results on the probability of your trading system. So what you then want to do is go out and replicate in the markets what you've tested. You don't want to deviate from that at all. You literally want to build the rules off of your backtested plan and say, this is what I'm going to do going forward. And it's a set of tangible rules that says, this is the results you're likely to expect. So go out and do that.
Based on the historical data looking at those trades. Okay.
So if you've got a system that provides a return of 40%, 50% return on investment per year, you want to stick with it. You want to go with that, right? You don't want to tweak it. But the amount of people that then get that and then go out and start breaking the rules and then going, why am I losing money? Or the other problem that they do is they test one market, and because that's profitable, they bring in another market and they assume that the strategy works on that market.
Oh, they try to take that strategy and apply it to a different market entirely?
Because they can't be bothered to test it, right?
Because that's probably, is this the most time-consuming aspect of it?
Yeah, it takes around, it takes me around 20 hours per market to test.
To back test it.
And I would say that you need to test one market, one strategy, one time frame at a time. So you don't want to be jumping around strategies. You don't want to be jumping around markets. You just want to get one whole set of results done.
Sure.
And it's going to take about 20 hours to do one.
Yeah, that's funny how that is. The most time-consuming piece is usually the most important piece, and then people just skip it because they're like, I'm not going to be bothered to spend 20 hours if it's, and it's really, if that's the differentiator there between the successful and the unsuccessful.
It really is.
It's amazing, but I certainly believe it.
Yeah, I want to give you guys the realistic expectations, and if you don't do this, you're going to have a very hard time. Just get it done, and it is grueling. It's horrible. It's the worst part. It is.
Is it just sitting there on looking at chart after chart, looking at the outcome?
Tick by tick.
Okay.
You know, going through the rules. If this happens, then I'm looking for this. If that happens, then I'm looking for that. And then you're setting your entries, and I'm going to give you guys an example on the spreadsheet on how to do that. And it is just horrible. I mean, I didn't speak to my wife for 3 months when I was doing the testing, and it is horrible. But that's what's required in the grand scheme of things. It's not a lot of time, but you've just got to get it done.
Yeah, you just got to get through it. There's certain aspects. Well, that's the way it is with anything. And you saying, having been involved in different businesses, there's certain parts of it that you love, and there's certain parts that you hate, but they're equally important.
Absolutely.
You know, and you kind of have to get through those parts that might not be so glamorous or interesting to you. You know.
Of course. And it is. I mean, lots of people don't talk about backtesting as because it's not very glamorous.
Yeah, that's not going to sell this when you sit. If you have people are trying to sell their programs, if you sit there and say you're going to hate this, it's going to be grueling. I didn't talk to my wife for 3 months. That's not a great sales pitch. You
Buy
know?
my stuff. Yeah,
exactly. But buy it anyway. You know.
Exactly.
But I think that's why people really appreciate you, is because you're so honest.
Yeah.
And it's almost kind of takes people back that you're this honest, because there are a lot of very shady people involved in trading in particular. You see a lot of it.
Yeah, and I get that. And there's people, you know, the trolls on YouTube, and they retaliate, and I get that, because they have been led up the garden path, and they're like, oh no, I've actually got to do some work. This can't be true. I'm going to just, no, you're telling lies, and it's sort of like denial. But you know, you can see from the people that I work with and the community I'm in that my only motivation is to give people the truth based on my own experience.
Absolutely, yeah.
And if you take one of my private clients, for instance, he applied the strategy, tested a couple of pairs, and then he just went and assumed that it worked on all the markets, right? So he was trading for 2 years, just slowly bleeding money, and he wasted 2 years of his life until I said to him, right, show me your backtested data, and he said, I haven't got any. And I said, well, you've got to go and do that, and I'm going to give you 3 months to do it. He went back 3 months later, he had all the tested data, I was checking it all through, I was spot checking everything. He then produced a report that said, this pair wasn't profitable, that pair wasn't profitable, this pair wasn't profitable with that pattern, this pair wasn't profitable with that pattern.
Sure.
He knew to take out all of that stuff, and it changed him from being bleeding money over 2 years to doing 3.5–4% per month in 3 months.
Amazing.
So
and it just seems silly to me if that takes, maybe, okay, it is a grueling process, but if it just takes that certain amount of time to then waste 2 years doing it wrong because you don't want to start and have that proper foundation, it's just like crazy to me. But
and if you think about it, it's just because they didn't go back to the start of this video and actually want it. They haven't got expectations.
Sure.
They don't know why they're doing it. Mm-hmm. And that's why this process is absolutely crucial.
All right, lots of people overcomplicate backtesting. They don't know where to start. They ask me if we can automate it or use a mechanical system, and my answer is always, it's always best to do it manually. I like good old Excel, and I'm going to show you a spreadsheet that we've developed, very comprehensive spreadsheet that does all of the calculations for you, and it's also a journal, and it also does your money management. But I'm going to just show you in Excel first, just so you can grasp the concept of backtesting, because it really is easier than you think. So there's a few things you want to pay attention to when we're backtesting. So the first column, I'm going to put the market. So in our instance, we're trading Forex. So I'm just going to write the pair. So that will be the Aussie CAD, or in our example of the double top that we just went over, it was the euro dollar. So the first thing we want is the market, or the pair. The next thing we want is the time frame. So we want to know what time frame we are testing. If it's the 60-minute, the 15-minute, the 4-hour, the daily, or whatever. In our example, it was the 60-minute, but we want to make a note of the time frame. The next thing we want is the entry date. So we want to know where we got in. We want to know what date we got in. If we ever need to refer back, or we're crunching the numbers at the end and we want to find out if there's any periods that are unprofitable time and time again and we need to remove them, it's going to be important to have this information. So on from that, we also need the entry time. And lastly, we want to know the entry price, where we're actually entering, buying or selling. And once we're in the trade, we want to make a note of our stop loss level. So that's where we're going to be wrong. And then we want to know our target price. Okay, so where the target is. And then, of course, on the way out of the trade, we want to know everything in reverse. So we want to know the exit date, because the trade could go on for 1 day, 2 days, 3 days, whatever. We want to know the exit time. And, of course, the exit price. Now, the exit price is either going to be one of these two. It's going to be the stop loss or it's going to be the target, because we're either going to get stopped out or we're going to hit our targets. So the exit price will be one of these two, and we can use that combination to calculate the profit and loss at the end. So in this one, we can have the total pips or points. So let's go back to our example now and put some data into this table. Okay, so looking at our example here, we know that we had to wait for a test of this level right here before we entered, and we had to wait for the close of this candle before we entered, right? So if we hover the crosshair over this next candle, you can see that this is the 26th of April and it's at 8 a.m. So the first thing we can do is our pair, which is the euro dollar. So we're going to go euro USD. The time frame is the 60-minute chart, so we're going to go 60-minute. We know that it was the 26th of April, so we're going to put 20. You guys in America do it opposite to us, so 4/26/18. 17, sorry. Then we're going to the entry time, so 0800. And then what we're going to do is put in the entry price. Now we know that it was next bar market, so we're going to put the crosshair at this level here, and you can see on the right hand side of the chart it says 1.0946. That is where we sold the market, so 1.0946. Now our stop loss, I said, was 10 pips above the high. So we looked at the previous high and we said, right, it's 10 pips above that, so we was up at 0.961. Okay, so 1.0961, and then our target price was at a retest of these lows down here at 0.926, so 1.0926. Now what we want to do is we want to track what happened next. So the exit date was actually straight after, so this lasted 1 hour, this trade, a maximum of 1 hour. So the exit date is the same. We're going to copy that and paste it in there because I'm being lazy. The exit time was the same hour, so we're going to go 0800 again. And the exit price was, of course, our target price, so 1.0926. And then what we're going to do on this is, because we are selling the market, we're going to go our entry price minus our target price, which will give us the total pips. So you can see that the entry price was 0.946, take away 0.926, that's a 20 pip profit. And you can put calculations in here to automate this, but you can essentially see that we've got a 20 pip profit on that trade. Alright, so now I'm going to show you our spreadsheet, which is a lot more comprehensive. It actually works out everything for you. It's got some nice little charts here to show you your win percentage, your maximum losing streak, which is essential when we're setting that risk tolerance and our position sizing. We're looking at a massive sample size, so this is earlier on this year, and you can see that we've been logging trades on this particular project for a long time. This goes all the way back to 2009, I believe. If we just scroll up here, there's tons and tons of data here. And this essentially works it all out for you. In this case, we're taking 2 positions, so we're taking 2 targets. which is a little bit more complex, but it allows you to boost your account a bit more. And then what you can see that this actually logs the backtesting into a money management spreadsheet, which actually tells you what your position size should be. So it tells you the difference between fixed fractional and smooth ratio, and also you can set the level at which when you go above a certain profit, it triggers your position size so that then you increase your position size. And this is how we can, as I mentioned earlier, how we can really accelerate our returns when we're doing well, and then protect our capital when we're going through a drawdown. So you can see just here, for instance, that we're increasing our position size until we take a loss and then we drop back down. We then hit a winning streak until we take a loss and then we drop down, and then so on. So you can see how this takes, this in this instance, we took a $50,000 account to just under $1 million, and this is obviously over since 2009. So this is a 9-year process from taking 50 grand to $1 million, but pretty decent. Now this spreadsheet is very, very comprehensive, and you don't really need, something like this. But if you are treating your trading as a business, then I highly recommend that you have something a bit more complex than Excel. But just to go and backtest a strategy, hopefully you can see from now, from this little example here, how simple that can be and how you can really be on your way to go out and start testing these strategies.
Now, something else I want to ask as well. Can this be a hobby, or is this something you really have to be all in about? I mean, can you just day trade casually, or get involved with trading casually, where maybe a couple of days during the week you want to sit down and trade, or do you really have to have that dedication to this?
Yeah, that's a really great question, and the answer is no. You cannot dabble in trading. You have to show up. Summer months are going to be quiet. Christmas is quiet. The big institutional traders who move the market, they're the ones that go to the Hamptons for the summer.
Sure.
And you have to understand, we don't move the market. In retail traders, we have no power moving the market. It's all
That's the same way with retail stock market investors as well. Your buy order of 10 shares of Facebook is not going to move that share price,
Exactly. Yeah. So all we have to do is, during those slow periods, we just have to show up, because there's going to be maybe 1 trade, 2 trades that we catch that keep us afloat for the summer. And we're really looking at a return on investment over time here. We're not looking at, a consistent 100 pips per day or £1,000 per month. It's over time. You might have a month where you lose. You might have a negative month. You might have a break-even month. June for me was extremely profitable. May was flat. And then February was very profitable, and April was flat. So it's just looking at the average over time.
Okay.
And you have to show up. You have to be consistent.
But yeah, that is very interesting, because I'm sure a lot of people maybe don't want to go all in with this, and it's important to realize that it can't just be a hobby.
It can't be a hobby. You need to want it. You need to know why you want it. You need to have realistic expectations. You need to hold yourself accountable. You need to learn the right way, start at the beginning in the process, go through it the right way, and then you'll have the results that you want to do, that you want. It's as simple as that. The results are inevitable if you just go through that process.
Sure.
All right, so finally, let's just talk about results then. If you've gone through that process, realistic results. So people think that they're going to double their account week after week. That's absolutely ridiculous. What you don't want to do is risk so much that you've taken a big hit and you are now having to make up so much money just to get back to break even.
Sure.
I use a smooth ratio money management strategy, which I've been over. Some people who just get into trading use a minimum % risk of their account. So some people like to say 1%. I'd say that's a good start, right? You don't want to risk more than 1% of your account on any one trade. And if you can consistently do that and just focus on not breaking that, then it's going to take you a long time to be out of the game, right? You're going to have your chips. You're going to have your poker chips. If you blow 50% of your account, you've got to make up 100% of your account.
Yeah, I've mentioned that too before. People think like 50% loss, 50% gain, but that's not going to get you back where you started. If you have a 50% loss, you now have to double your money to start back.
And it's very hard to double your account. It's very, very hard to double your account. So realistically, in terms of results, what you're looking at is if you can be consistent and you can go through this process and learn the right way, you're looking at around 3, maybe 4% conservative per month, which compounds out to 40% per year.
Which can do astronomical things to your money. I mean, I know a lot of people don't understand the power of compounding. But I know it sounds like a little bit, but that has a huge impact on your.
Of course, and if you couple that with obviously passive investments,
sure.
And
then something else that we could also tie in here as well is, do you recommend that a lot of people maybe like take some of the profits from the high risk side of investing and put it into a more passive strategy?
So when I started trading well,
sure.
I was investing anyway. I've got automated systems that do my investments and everything. And when I started trading, I started splitting the money 70-30. So I had a 70-30 split. And then as I became better and better, I went to a 50-50. But absolutely, if you take some of the profits that you're getting from your investments and you put them into your trading account, then you're talking about a serious acceleration strategy there.
Or the other way around as well, where maybe you want to take some of your profits and put them into
an investment.
Passive strategy where,
absolutely, it works both ways.
So you don't have to be polarized there where you're one or the other. You can do a mix of both of these things.
No, just find your strength. Again, you're not going into trading as the be all and end all. This is another wealth acceleration strategy. It's not something that's the end.
Sure.
It's just going to help you achieve financial independence quicker. That's it.
Okay, Jason. Well, thank you so much for coming on the channel here.
Pleasure.
I certainly appreciate it. Where do people go if they're looking to learn more?
We've obviously been over a lot in this video, and there's a lot to take in. I recommend you go and rewatch it. And if you really are interested in learning more about how to trade the financial markets, you can find the website below this video.
Yep, everything's linked up in the description. What is it, Tier 1 Trading?
Tier 1 Trading, yeah.
And then you also have a YouTube channel as well where you're pretty active, posting videos on a consistent basis.
Yep.
Okay.
Yep. So everything's below, and hopefully be working with you soon.
All right, well, thanks so much for coming on, and thank you guys for sticking around and watching this whole video. And if you guys want to see more videos like this where I talk to different experts out there, let me know down in the comments section below. I'd love to hear your feedback. All right, see you guys later.
All right, guys, so that was the video. As I said in the video with Ryan, if you're interested in learning how to trade and you just want to get your feet wet and you don't want to get scammed, or you don't want to kind of be duped into forking out loads of money for something that you might not actually like, Tier 1 Trading offer a range of free trainings. You just go to tier1trading.com/free. Links below, and you can check out that. You can come and spend 2 weeks in the live trading room with myself and Akil, and you can come and join the community, learn from them, see what they have to say. You can use the tools, and you can do all the free training in there as well. So nothing to lose. Hit the link below. And if you're more interested about the wealth creation as a whole, I run a program called Tiers of Freedom, and it's exactly what I did from when I was 21 up to 29 to completely replace my income. So if you're more interested in that, links are below as well, and you can also check out podcasts, newsletters, where I share lots of free information. So hope you enjoyed the video. Please share it with anyone who's looking to get into Forex or trading. And I'll see you until next time. Take care, have a great rest of your day, and I'll see you then.
Everyone wants to live an inspired life, yet so many people search for happiness following the footsteps of peers and taking advice from people who have different values and outcomes to which they're searching. There are people born into wealth, graduated from the best universities in the world, and there are people who have none of that and yet are living extraordinary lives full of fulfillment and reward. The purpose of this is to share insights and strategies that allow you to question the status quo and think freely, so you can design your life and be who you want to be. We get one life. Time is our most valuable asset. I believe that when we're free and able to focus on meaningful work, we become better human beings. This is always free, and I'm your host, Jason Graystone.